Let me show you how you can become a millionaire by investing in leverage ETFs. So in this example, I'm going to be using the S&P 500 so you can see just how easy it is. So let's get into it. We're going to use a rate of return of 10%. If you just put 10% of your income, you will end up with over $9 million after 52 years. Somebody that starts at age 30, $2.8 million after 40 years. That's still quite a bit of money. Let's say you're 40 and you haven't started investing. You're still $5,400 away from a millionaire. Started at 20 years old. But by the time you are 49, you're literally a millionaire. If we go with age 18, you become a millionaire at 47. To become a millionaire long-term, it doesn't require you to invest in stocks. You don't have to do research. All you got to do is just make income. That's it. By the time you're 70, you're going to have over $9 million. That will get you into retirement and you'll never have to work again and you'll live very comfortably. But you got to be disciplined. Put that money in there every month and this will grow over time. That is how you become a multimillionaire the easy way. What's this trick with these leverage ETFs? Very risky. Lose most, if not all of your money. When the market goes down, you're not just going to go down 10%, 20%, 30%. You're going to be double and triple that most of the time. When you have a market going down like 30%, I mean, you could literally lose 90% of your investment in a 3x, and a 2x would be 2 times what the S&P 500 had lost. They're very risky, but on the upside, they can make you a ton of money. 2x, that would be the SSO. That would give you a 20% return. You went from 9 million to 374,800,000. That's after 52 years of being invested, which you say, hey, I ain't got that many years of my life to live. Okay, that's fine. Why don't we say that you're 30? You're getting a 20% return. So why don't we say you're 40 years old, 6.7 million, and you haven't put a dime into the market until you were 40. Look what happens when you're 18. You get 3x, $16,830,000,000. But these 2x and 3x ETFs have something that is absolutely crazy, which I'm going to share with you later in the video. Let's just say the average person is 25 years old that's watching this. And if you're getting a 2x return consistently, that is over 104 million. I think you can retire pretty comfortably off that. It really doesn't matter what your age. If you're using 2x and 3x ETFs, these are the kind of crazy numbers that can happen. I'm now going to share with you something that you need to know about is volatility decay and the magical compounding power of these leverage ETF that will actually blow your mind that you need to know about. What I've got up here is the S&P 500 index represented by the SPY ETF. So here I'm using a low of $80. Up here we have 379. If you bought the S&P 500, it gave you 474% return on your money since the March 2009 period, or what's equal to 4.74 times your money. So what I've got on the chart right now is the triple leverage S&P 500 ETF SPXL. You went from $2 to $75, a 3,750% return on your money, or simply put, 37.5 times your money. Now, logically, you would think using a 3x leverage ETF would get you 3 times the return of the S&P 500. No, you got 3,750% return. You think, well, how is that possible? It's a 3x leverage ETF. Shouldn't it just be 3 times the return of the S&P 500? Well, you would think so. So this is the crazy thing about this triple leverage ETF. It's actually more than triple leverage returns. So in this case, the triple leverage ETF SPXL really turned out to be a surprising and shocking 8 times leverage ETF, which is 8 times the returns of the S&P 500. The longer you go with these, the very different returns you can get. I should also mention that there is more good news. I'm going to show you the S&P 500 index, non-leveraged through the SPY, and we're going to go to the end of September in 2018. Right here, we had a high of 294 and a low 234.
Which was just a 20.4% drop.
And so for the same time period in the triple leverage SPXL ETF, you had a high of 56 and then it dropped down to 27.
That's a 51.8% drop. The loss was only 2.54 times that of the S&P 500.
Not the 3x that you might have expected. It could be very successful for you, but you have to be very, very careful. So the second example, which happened during the pandemic of last year, 2020, the triple leverage ETF SPXL, on February 28, it had a high of 76 and it dropped all the way down to 17.
That was a 77.6% drop.
So looking at the SPY ETF, had a high of 339 for the same time period, and it had a low of 218, which was a 35.7% drop. So when you compare the two, the loss was only 2.17 times of the S&P 500, not the 3 times that you would have expected. But the math behind how these leverage ETFs are calculated is very complicated, so we won't get into that here. But as you can see, these leverage ETFs can give you monster returns beyond what you might expect, and of course losses likely closer to 2 times the S&P 500 and not 3 times. But there are things that kind of put a monkey wrench in some of that, and I'm going to talk about that here in just a minute. They're highly risky, and frankly, you cannot just go investing in these and use dollar cost averaging and expect to survive the long term. It looks good, I know, but we've been in a bull market for 11 and a half years. You cannot expect that to continue like that all the time. It's more likely you get wiped out or you lose a ton of money because of the built-in leverage that cuts both ways. But there's some in-between times the market doesn't really go anywhere. And that's the next thing I need to talk about, because that will cut into your returns. Timing is huge with these things, and if used correctly, you can manage to avoid disasters and make out really well. This is the big thing I was alluding to that you need to know about that will impact returns of these ETFs from time to time. That is that these ETFs need to reset their leverage to the market each night after the close. So unfortunately, this results in a repeated process of buying higher highs and selling lower lows. This is what I refer to as volatility decay. Volatility decay is your enemy in sideways markets. For example, if you look at the S&P 500 ETF, the SPY or VOO, they go up and down for a few weeks or months, making no ground and zero gains or loss. If you're invested in the 3x or 2x leverage ETFs, you're going to actually suffer losses as a result of volatility decay. Now, I use various leverage ETFs in both my trading and investing to increase my returns. Now, I've used them for years and understand their Jekyll and Hyde price behavior and know how great they can be and how devastating they can be if used in the wrong way under the wrong conditions. We've had literally almost perfect conditions since 2009, and of course that's not going to last forever. So I just wanted to share how good these ETFs can be and how you can become a multimillionaire and become rich a lot sooner than you might have expected. But if you've got the guts for it, it can definitely pay off big and you become a multimillionaire just starting with a little bit of money, and it just keeps compounding. So if you choose to invest or trade in these, be extremely careful, and let's go make some money.